Assalamu alaikum dear students. I hope you all are fine and safe. I am Dr. S.M. Ali TIrmizi, your teacher and guide of corporate governance course. Today we will discuss chapter number 10, that is financial reporting and external audit. This chapter is very important for you to understand. The main topics that we will cover in this chapter are listed in the next slide. I hope you will find this video lecture useful to clear topics and concepts of chapter number 10 of corporate governance. In chapter number 10, the major topics that we will be covering starts with the introduction of the chapter. Then we will discuss the second topic, that is the audit committee. The third topic is accounting quality, transparency and controls. Fourth topic is financial reporting quality. Then we will discuss financial restatements as the fifth topic of the chapter. The sixth topic is models to detect accounting manipulations. The seventh topic is relating the external audit, which include further subtopics relating external audit process, and these subtopics are audit preparation, review of accounting, estimates and disclosures, fraud evaluation, assessment of internal controls, communication with the audit committee, and expressed opinion. Then class, we will discuss the eighth topic of the chapter number 10, which is structure of audit industry. And under this topic, I will share with you an online YouTube video relating structure and condition of audit industry. Also, you will get insight relating opinion of expert auditors. After this, we will discuss ninth topic of the chapter, which is external auditor as CFO. And the last topic of this lecture is auditor rotation. At the end of this lecture, I will discuss with you the Harvard Business Review article reading assignment, as well as details relating quiz of this chapter in the next week. All these details have been uploaded on the Corporate Governance Microsoft Class platform. In this chapter, we will examine the process by which the Board of Directors assesses the integrity of published financial statements by a company. It is very important to mention here that the accuracy of financial reporting is essential to be focused by a Board of Directors for several reasons. First, this information is critical for the general efficiency of capital markets and the proper valuation of a company's publicly traded securities. Second, an informed evaluation of a company's strategy, business model, and risk level depends on the accurate reporting of financial and operating measures. Third, the Board of Directors award performance-based compensation to management based on the achievement of predetermined financial targets. Therefore, accurate information that relating to the financial reporting is critical to ensuring that results are stated honestly and that management has not manipulated results for personal gain. Additionally, in this chapter, we will discuss the general obligation of the audit committee to oversee the financial reporting and disclosure process. The questions which are important relating this aspect include: what actions should the committee take to ensure that financial data is reported accurately? How can it decrease the likelihood of material misstatement or manipulation by the management? How effective are these efforts? Furthermore, in the end of the lecture, we will also evaluate the role of the external auditor and try to answer the questions including: what is the purpose of an external audit? What it is expected to accomplish, and what is it not expected to accomplish? Class, now we will discuss the first topic of chapter number 10, which is the audit committee. This topic is relating the discussion of broad range of responsibilities of the audit committee. These responsibilities mainly include to oversee financial reporting and disclosure, to monitor the choice of accounting principles, to hire and monitor the work of the external auditor, to oversee the internal audit function, to oversee regulatory compliance within the company, and to monitor risk. Many of these responsibilities are mandatory by Securities and Exchange Commission and by the law of a particular country. In the case of Pakistan, Securities and Exchange Commission of Pakistan has the rules and regulations under the Companies Act 2017 which are applicable in such conditions. There are other responsibilities which are not mandated by law but instead have evolved from historical practices. For example, the assignment of enterprise risk management by the audit committee is not a legal requirement, but many companies make violations in completing this responsibility. In such conditions, it is advisable to include financial expert committee member who can guide the audit committee in this situation and related matters. The third topic of this lecture is accounting quality, transparency, and controls. The work of audit committee begins with establishing guidelines that dictate the quality of accounting used in the firm. So accounting quality is generally defined as the degree to which accounting figures precisely reflect the company's change in financial position, earnings, and cash flow during a reporting period. Financial Accounting Standards Board in the United States and the International Accounting Standards Board act as outside oversight bodies and ensure implementation of accounting standards by the firm in a particular country. The matters relating standards for allocation of cost to the project, value allocation to a transaction, revenues recognition are considered in terms of implementation by the management of the firm. The audit committee must also establish the company's standards for transparency. Transparency is the degree to which the company provides details that supplement and explain accounts, items, and events reported in its financial statements and other public filings. Transparency is important for shareholders to properly understand the company's strategy, operations, risk, and performance of the management. It is also necessary when shareholders make decisions about the value of the company's securities. The audit committee is also responsible for monitoring the internal controls of the corporation. Internal controls are the processes and procedures that a company puts in place to ensure that account balances are accurately recorded, financial statements reliably produced, and assets adequately protected from loss or theft. Therefore, effective internal controls act as the cash register of the corporation, which is a system that confirms that the level of assets inside the company is consistent with the level that should be there, given revenue and disbursement data recorded through the accounting system. It is essential that the audit committee determines the rigor of controls necessary to ensure the integrity of financial statements. A rigorous system is important for protecting against theft, tampering, and manipulation by the management or any other employee. It is also important for detecting potential regulatory violations or illegal activity such as the payment of bribes. Rigorous controls help ensure that employees do not make inappropriate adjustments to company accounts to create falsified results. Excessive controls can lead to bureaucracy, lost productivity, inefficient decision making, and an inhospitable work environment. Therefore, the audit committee must strike a balance between proper controls that prevent inappropriate behavior and excessive controls that impact firm performance. The fourth topic of this lecture is financial reporting quality. There are several control mechanisms, as these are discussed earlier in the slide, which are in place to assist the audit committee in ensuring the integrity of financial statements. Companies normally hire an external auditor to test financials for material misstatement based on prevailing accounting rules. The external auditor reports its findings directly to the audit committee to ensure that the audit process has not been compromised by the management influence. Companies also employ an internal audit department which is responsible for separately testing accounting processes and controls. Companies that violate accounting regulations face the risk of lawsuits from shareholders and regulators. Now, further a discussion relating financial reporting quality. Audit committee members normally show confidence that their accounting controls are effective. According to the KPMG survey data from USA, 89% of audit committee members are confident or very confident that the company's internal audit department would report controversial issues involving senior management. 86% are satisfied with the support and expertise they receive from the external auditor. However, according to empirical evidence, it is suggested that the accounting controls might not be as effective as audit committee members believe. So, relating this fact, a research study conducted by DeKalb, Graham, Harvey, and Rajgopal in 2013 reported the results of this survey conducted from 169 chief financial officers. These authors found that about 20% of reported firms had manipulated earnings to misrepresent economic performance. The average level of earnings manipulation among these firms was 10%. This empirical study suggests that management might regularly sidestep internal controls to meet earnings targets. Many other research studies support these empirical findings and conclusion. Now class, watch an online video relating how we can assess the financial reporting quality of a company effectively.
Now we'll look at the context and how you want to assess financial reporting quality. First, we'll talk about some motivations that could exist why management would want to have poor quality results coming out. One is they simply want to mask poor performance. So if they have poor performance in a period, they would rather report good news, so they'll simply massage the numbers a little bit so they can report better news. Also, oftentimes they want to beat market expectations. The analyst forecasts are out there. They want to beat those analyst forecasts because that will be a positive jump in the stock price. So they're going to do whatever they can, even if it means manipulating the numbers to get those results that they want. And then they may have career concerns or incentive compensation. So they're more likely to have a good career if the company is going to produce good results. So that's why they would want to have the bias in good results. Also, their incentive compensation could be tied to the current period results. So they simply want to meet whatever hurdles they have set so they can maximize their bonuses for that period. And then finally, they may want to avoid debt covenant violations. So if they've borrowed money, there's going to be triggers in there that are set such that they have to have a sufficient amount of earnings to be able to support that debt. So they don't want to drop below that trigger point. Otherwise, there's going to be ramifications in the debt that they have. There's some conditions that are conducive to issuing low quality financial reports, and that includes opportunity, motivation, and rationalization. The opportunity can arise if you have poor internal controls. So you don't have the controls set up that are going to catch or even prevent people from doing this. Also, when you have accounting standards with a lot of flexibility, that gives management too much leeway so they can adjust the results to get the benefit or to get the results that they want. Then with motivation, if they have pressure to meet criteria for personal gain, like getting bonuses, then they're going to have that motivation to actually adjust the results, to get those poor quality results because they personally want to get that bonus. And finally, most of us want to rationalize our decisions. So you could rationalize your decision, even though deep down you know it's wrong. You could rationalize it by getting other people on board with you. So you could get other management to approve of it. You could even go to the board and get them to approve of this approach. So then you've rationalized it's an acceptable means of reporting. But there are mechanisms out there that discipline financial reporting quality, and you want to discipline it so you can actually keep it in the higher range. There's three different ways they discuss here that you can discipline. It could be from market regulatory authorities, it could be from external auditors, or it could be from private contracting that's going on. So one of those three ways can actually help discipline the financial reporting process. So first, on the market regulatory authorities, they do many different things that try to keep a disciplined process to keep high quality and reported earnings. One is a registration requirement. Before you can sell securities to the public, you have to create these registration forms that are going to give lots of information about the company and what it is you're doing, and they're going to check those reports to make sure that you're doing it accurately. Then also disclosure requirements. Periodically, they're requiring companies to file these reports. They're telling you what has to be in the reports, the format that it has to be in. Standard setting bodies are going to set the standards, and then regulators are going to enforce them. So oftentimes the regulators don't have the infrastructure to actually create the standards, so they can look to a private body to create the standards, but then it's their job to actually enforce them. Many have auditing requirements, so you have to get an independent auditor to come in to really write the opinion that you're adhering to the generally accepted accounting practices for that particular jurisdiction. Also, sometimes they have to write an opinion that you have proper internal controls that are going to prevent bad reporting. Management commentaries are going to be needed. That's a review of the business and the principal risks that you may have. So they're requiring management to write that out. So it's helping the investors see what's really going on. There's responsibility statements that must be signed. So that means the person that is providing the information has to personally sign on those statements. So it does give them a little bit of exposure, so it makes it more incentive for them to actually report this accurately. And then regulatory review of filings, just to make sure the rules have been followed. And then enforcement mechanisms can range from fining companies to actually suspending companies. So they can take a pretty extreme approach here if the companies are not doing what the regulators say they're supposed to do. So another means of discipline is having an auditor. It's usually required that you have an independent audit of your results. So you have to get an independent accounting firm to come in and look at your books to make sure you're doing everything correctly. What you would like to get out of that is an unqualified or a clean opinion. That just means the auditor is going to say, yes, you're doing everything that you're supposed to be doing in terms of following the rules for the generally accepted accounting principles. But there are limitations to these audits. The auditor is relying on information that's provided from the company itself. So to the extent the company is not providing good information, the auditor really can't do a good job. Also, it's based on sampling, so they're not reviewing every single transaction that took place, just a sample of those, so they certainly could miss some ones that did not go well. And the audit is not intended to detect fraud. So if the company is intentionally trying to hide things, the audit really is not set up to find that. Rather, the audit's just trying to make sure they're following the accounting standards that are in place, but again, not to detect fraud. And another point is the company is the one that's paying the auditor to audit them. So that creates a little bit of conflict of interest because the auditor doesn't want to get on the company's bad side. Otherwise, they may not get to do the audit the next year. So they're going to be a little bit more lenient because they want to actually keep that engagement for the next year. And finally, the last discipline that could be used is private contracting. That just refers to such things as a loan agreement. So if a lender loans money to a company, there's going to be some agreement. The lender's going to have a vested interest in making sure the reporting quality is high because they need to assess where the company is really at to know, is it still a safe investment or is it not?
The fifth topic we are going to discuss now is the financial restatements. A financial restatement occurs when a material error is discovered in a company's previously published financials. So, in this case, investors become alert that previously published financials can no longer be relied upon and are under review for restatement. If an error is not material, the financial statements are simply amended. According to data from the Center for Audit Quality, between 700 and 1,700 restatements occur each year. Of these, approximately 15% are issued by foreign companies which are listed in the United States. The most frequent cause of a restatement include improper expense recognition relating to accruals and reserve estimates. That was 30% of errors related to accounting for debt, and equity financing was 23%. Improper revenue recognition was 14%. Errors related to accounting for fixed assets and intangible was 13%. Improper expense recognition related to stock-based compensation was 13%, and tax accounting errors was 11%. It's definitely human error, which results in the restatement of financial statements. So, a behavioral component is likely involved in financial restatement by the companies. This fact denotes that financial restatements tend to have a negative impact on companies well beyond the announcement date and is most probably correlated with weak governance and regulatory controls. The sixth topic of this lecture is relating models normally used to detect accounting manipulations. Therefore, in this regard, several researchers have developed models that use abnormal accruals to predict financial restatements. One widely used model was developed by Dicao, Solan, and Sweeney in 1995, based on a modification of John's work in 1991. Further to this, Benish in 1999 tested his model by using data of companies that have restated their earnings as well as companies that have not restated their earnings. He found that accrual-based models tend to have a very modest success rate in predicting future restatements. There is another company named as GMI Ratings, which is now a part of MSCI Incorporation, based in New York, United States of America. GMI Ratings has also developed a model with a slightly higher success rate in predicting financial restatements. This company, GMI Ratings, used a composite metric that aggregates both accounting and governance data to identify companies at risk of restatement and other negative outcomes such as fraud, debt defaults, and lawsuits. GMI Ratings computed accounting and governance risk scores on a scale of 0 to 100, with low ratings indicating a higher likelihood of restatement or adverse outcome. GMI Ratings claims that companies that have the lowest score normally account for 31% of all restatements, whereas companies that have highest score account for only 3.1%. And it is also very important to mention here that high risk companies substantially more likely to face a restatement than the low risk firm. So independent testing has confirmed that accounting and governance risk model is more powerful as compared to standard accrual based model. The seventh topic of this lecture is the external audit. The external audit basically assesses the validity and reliability of publicly reported financial information. Shareholders rely on financial statements to evaluate a company's performance and to determine the fair value of its securities. The management of the company is responsible for preparing this information, and the shareholders expect an independent third party to provide assurance that the information they receive is accurate. Therefore, in this situation, the external auditor serves the purpose. All across the globe, external audit by the independent audit firm is a must. Therefore, in Pakistan, a listed firm is required to be audited by the external auditor, which ultimately verify the quality and accuracy of the financial statements of the company. The external audit process is divided into 6 steps, which starts from audit preparation, then review of accounting estimates and disclosures. Third step is fraud evaluation. Fourth step is assessment of internal controls. Fifth step is communication with the audit committee. And sixth step is expressed opinion. Now we will discuss these steps in detail. In audit preparation, the auditor and the audit committee discuss and determine the scope of the audit. Here the auditor uses professional judgment to determine how best to perform its assessment. This involves identifying areas that require special attention, evaluating conditions under which the company produces accounting data, evaluating the reasonableness of estimates, evaluating the reasonableness of management representations, and making judgments about the appropriateness of the manner in which accounting principles are applied and the adequacy of disclosures. In review of accounting estimates and disclosures, the audit is predicted on a sampling of accounts. Highest attention is paid to the accounts that are at the greatest risk of inaccuracy. These generally include revenue recognition, restructuring charges, impairments of long-lived assets, investments, goodwill, depreciation and amortization, loss reserves, repurchase obligations, inventory reserves, allowances for doubtful accounts. So our auditor review and test all the processes by which estimates are developed, calculated, and transactions are recorded by the management of the company. In fraud evaluation, the main objectives of the audit is to test for validity and reliability. So to determine whether fraud has occurred, auditors evaluate the incentives and pressures placed on the management of the company. In the case of assessment of internal controls, the auditor assesses the design of company's level controls, the controls relating to risk management, significant accounts and their disclosure, the process of developing inputs and assumptions for management estimates, and the use of external specialists who assist in preparing estimates. In the case of communication with the audit committee, the external auditor discusses its findings with the audit committee. The auditor's communication with the audit committee include an assessment of the consistency of the application of accounting principles, the clarity and completeness of the financial statements, and the quality and completeness of disclosures. In the sixth and last step of external audit, the ultimate objective of the audit is to express an opinion on whether the company's financials adequately comply with regulatory accounting standards. If the external auditor finds no reason for concern that the financial statements of a company are materially misleading, the firm expresses an unqualified opinion that accompanies the financial statement in the annual report. Alternatively, the external auditor issues a qualified opinion and explains the reason for concern. All this activity being done by the external auditor is in accordance with the generally accepted accounting principles, rules, and standards for financial reporting. Now class, watch an online video relating the KPMG perspective which explains the evolution of audit that is taking place in the industry.
When you think about it, everything around us has evolved in some form or another. Our technology has evolved, our transportation has evolved, and we've evolved too. Evolution is progress. It's how we make things better, faster, more efficient, and more effective. So it shouldn't come as any surprise that the audit function is evolving too. But why does it need to evolve? A lot has changed since the economic crisis. And today, boards and audit committees are asking and expecting more from their audit. As a result, the audit has been utilizing more and more technology to meet these needs. This video will highlight two of these new processes. Let's begin with data and analytics, or what is also referred to as DNA. In the past, audits have typically started with a client interview that involved vast amounts of paper-based material. Today, auditors are likely to also meet with your IT department to set up access to the company's data systems. Then they use data mining and aggregation software to download the information they need. All this raw data is run through a DNA engine that drills down through the numbers with much more clarity than ever before. That's because we can now review and analyze 100% of your financial data, not just a few samples. As a result, you can see your financial picture with much more clarity than ever before. DNA technology can also aggressively analyze and compare performance over the last 3 years to make sure the relationship between the numbers makes sense. This allows auditors to isolate anomalies or outliers that may be indicators of control weaknesses, errors, risk, or potential fraud. This ability to analyze data at a more granular level delivers the insights clients want and need. Insights they may then leverage to improve business functions. While DNA focuses on quantitative information, Lean in Audit evaluates the client's processes from a qualitative perspective to better understand why things are happening in their organization. The audit team applies proven lean methodologies that are common in many industries to both the organization's financial and operational processes. Lean in Audit uses simple visual and collaborative techniques to engage key stakeholders across the entire organization. And because this work is business-centric, the auditors, through the execution of the audit, can identify high-value performance improvement opportunities. When Lean is embedded into our financial statement audit, we get a better understanding of the organization's end-to-end processes, enabling us to provide our clients with recommendations and insights that may help them make better informed business decisions, improve product quality, lower costs, increase profitability, strengthen customer service and satisfaction, and drive overall performance. In the end, we are able to deliver a better and higher quality audit. And from the client's perspective, they see a significant increase in value as the insights provided may help bring their financial and operational processes into sharper focus. Together, DNA and Lean in Audit can work independently or in tandem to provide today's business executives with new incremental information they want and need. Both approaches are designed to add value to the audit and increase audit quality. Their combination of qualitative and quantitative analysis helps business executives understand why things happen the way they do. So with DNA and Lean in Audit, you don't just get insight or understanding. You get insight with understanding. As a firm that provides quality assurance services and insights in the audit space, KPMG continues to be recognized as a leader in the marketplace, capable of providing clients with an enlightened perspective on their business.
The eighth topic of the lecture is structure of audit industry. The audit industry is characterized by extreme concentration among four main firms: Deloitte and Touch, Ernst & Young, KPMG, and PricewaterhouseCoopers. Together, these firms are known as the Big Four. Most countries require that audit firms be owned and managed by locally licensed auditors. Like in Pakistan, there are multiple other audit firms like AF Ferguson and Company, BDO Ibrahim and Company, Riaz Ahmed and Company, and there are many other that are working in Pakistan. Now class, watch an online video relating what auditors do to audit the financials of a company.
Auditors audit financial statements. So the idea is that they go through the financial statements and express an opinion as to whether the financial statements fairly present the position of the company. In order to do that, first they do a risk assessment. So they assess the different levels of risk in the company and they look at where they should be spending their time, when things are more likely to be misstated. Then they get evidence. You can't just accept everything you are told. You need to maybe sometimes go and look at documents, contracts, interview people, etc., outside confirmations, whatever is necessary. And then they analyze that evidence and they report on it. The report is normally attached to the financial statements where they say that the financial statements are fairly presented or not. If you look at the annual report of a company, you will find that actually quite a small part of the annual report is financial statements. The rest of the annual report contains comments and forecasts, and there's even some management information. There's even some marketing information in it. Auditors can't audit that. Auditors audit the financial statements. We can't ignore the rest of the annual report. Obviously, we have to read it, and we have to see that it is not contradicting the financial information or that there's no blatant inaccuracies in it. But we only really audit the financial statements. Remember, we are all somehow interested in financial statements. Whether you invest in a company directly, or maybe you're a member of a pension fund, or your parents are members of a pension fund, financial results of companies are important to all of us. Now, those financial results are prepared by people, and they are reviewed by people, and then they are read by people, management, directors, auditors, standard setters, everyone. Now, in this whole chain of events, auditors are very important because they are independent. They are separate to management and the directors and the owners. They don't have a stake in the company. One, they don't have a stake in the company, and secondly, they're also trained in reading and using financial statements. So that's why it's very important that auditors are part of this chain of producing financial statements. It gives it credibility because the auditors say whether the financial statements are fairly presented or not.
The ninth topic of the lecture is external auditor as CFO. A company might find it beneficial to offer a job to a member of the external auditing team in either the finance, treasury, internal audit, or risk management departments. Or hiring a former auditor has several advantages to the company. In these situations, the company has had the opportunity to witness their working style, knowledge, and expertise firsthand. Therefore, hiring a former auditor allows a company to benefit from lower training costs and more reliable cultural fit. These decisions may have drawbacks for the company and could damage the audit quality. The 10th and the last topic of this lecture is auditor rotation. Here, auditor is the external auditor being hired by the company. So it's very essential for the companies to rotate the external auditor periodically to ensure its independence and at the same time decrease the risk of fraud. This approach argues that over time, audit firms grow stale in the review of the same accounts and that a new audit firm brings fresh perspective to company procedures. In order to eliminate personal relationships of audit firms with the company employees, it's very important that external auditor must be changed with the new one. Dear students, you have to use Microsoft Teams Corporate Governance class platform to read an article 10.1. The title of the article is Where Financial Reporting Still Falls Short. This is a Harvard Business Review article and it's very interesting article. This article has already been uploaded on Microsoft Teams Corporate Governance class platform. So after reading the article, you have to use Microsoft Word Online and type 1 to 2 pages article review in your own words, and then you have to turn it in under the Assignments tab on Microsoft Teams class platform of corporate governance. The assignment 10.1 submission deadline is also mentioned on Microsoft Teams class platform. The quiz details for chapter number 10 is also being mentioned on the class platform, and that will be between 15th to 19th June 2020. So you must prepare this chapter very well. Okay class, that's the end of lecture relating chapter number 10 of corporate governance. I hope all of you have gained knowledge relating topics and concepts covered in this lecture. Now you will see me in the next video lecture relating chapter number 11 of corporate governance. Before closing this session, you all are advised to complete and submit assignments assigned to you relating chapter number 8 and 9 of corporate governance. You must also prepare these chapters for the quiz in the next week. Until then, goodbye, Khuda Hafiz.